Before we begin, a quick and important disclaimer. This video is intended for educational and entertainment purposes only and does not constitute legal, financial, or tax advice. The division of retirement assets, specifically 401k accounts, is governed by complex federal laws such as ERISA and specific state statutes that vary significantly across the country. Because every marital and financial situation is unique, the potential outcomes discussed here are based on historical trends and general case studies. You should not take action based solely on this information. Always conduct your own due diligence and consult with a qualified family law attorney or a certified financial planner in your specific jurisdiction before making decisions regarding your retirement or divorce proceedings. Imagine working for 30 years in a local manufacturing plant or a regional utility company in a small town in the Midwest or the heart of Appalachia. You have diligently contributed to your 401k, watching that balance grow through every market cycle, believing it is the bedrock of your quiet, rural retirement. Then the unthinkable happens. The marriage ends. In many of these tight-knit U.S. rural communities, there is a devastating misconception that because your name is the only one on that account, the money belongs solely to you. This single mistake is currently causing a silent financial epidemic across rural America. We are seeing cases where individuals lose 50% or more of their life savings in a matter of months, not because of a market crash, but because they didn't understand the specific legal mechanisms that govern 401k division during a divorce. In rural communities where the cost of living is often lower but the access to specialized legal counsel is limited, the stakes are exponentially higher. For a couple in a major metropolitan area, a 401k might be just one of several large assets, alongside high-value real estate or equity portfolios. But in a rural setting, that 401k is often the only significant liquid asset outside of the family farm or the primary residence. When that account is split, it doesn't just change your retirement date. It can fundamentally alter your ability to survive in the community where you've spent your entire life. In this deep dive masterclass, we are going to pull back the curtain on the 401k divorce phenomenon specifically through the lens of rural U.S. life. We are solving the problem of information scarcity. Today you will learn exactly how these assets are categorized by the courts, the catastrophic tax traps that catch rural families off guard, and the critical role of a document you've probably never heard of, the Qualified Domestic Relations Order, or QDRO. By the end of this series, you will have a comprehensive understanding of the historical trends and case studies that define how retirement is carved up in the American countryside, ensuring you are not left in the dark when the gavel drops. To understand why this is such a volatile issue in 2026, we have to look at the intersection of state law and federal protection. Most 401k plans are qualified plans, meaning they are protected by the Employee Retirement Income Security Act of 1974. While federal law protects these funds from creditors, it does not protect them from a spouse in a divorce. In the eyes of the law, the contributions made during the years of marriage are often considered marital property, regardless of whose paycheck they were deducted from. Consider a case study of a couple in rural Ohio. The husband worked 25 years at a local grain elevator, amassing a 401k balance of $400,000. The wife stayed home to raise their children and manage the household, a common dynamic in many traditional rural areas. Upon filing for divorce, the husband assumed the 401k was his personal reward for his years of physical labor. However, under the principle of equitable distribution, the court viewed those 25 years of contributions as a joint effort. The shock of realizing that $200,000, half of his entire life's work, was subject to transfer to his soon-to-be ex-wife created a financial tailspin that could have been mitigated with proper education. The problem is compounded in rural areas by the valuation gap. In a city, you might have easy access to forensic accountants who can pinpoint the exact premarital versus marital value of an account. In a rural county, you might be working with a general practice attorney who handles everything from traffic tickets to property disputes. If that attorney isn't well versed in the nuances of 401k valuation, they might miss the active appreciation versus passive appreciation of the funds. For example, if you entered the marriage with $50,000 already in your 401k, that initial amount is typically separate property. But if that $50,000 grew to $150,000 during the marriage due to market gains, who owns that $100,000 increase? Different states have different answers, and in a rural court, the lack of specialized testimony can lead to outcomes that deviate significantly from a person's expectations. Furthermore, we must discuss the liquidity trap. In many rural divorces, There isn't enough cash on hand to buy out a spouse's interest in a retirement account. If the house is worth $150,000 and the 401k is worth $150,000, a common tabletop agreement is for one spouse to take the house and the other to keep the retirement. On paper, this looks like a 50-50th split. In reality, it is a financial disaster. The spouse with the house has a $150,000 asset they can live in or sell. The spouse with the 401k has a $150,000 asset that is entirely tax-deferred. When they eventually go to withdraw that money in retirement, they might pay 20 or 30% in federal and state taxes. Suddenly, their half is only worth $110,000, while the house-owning spouse kept the full $150,000. This is the kind of subtle inequality that drains the wealth of rural families who don't have the big city financial advisors to spot the discrepancy. We also have to address the specific cultural pressures of rural communities. There is often a higher social cost to these financial battles. In a town where everyone knows your business, the public nature of a court-ordered 401k split can lead to stalled negotiations or, conversely, one party giving up their fair share just to avoid the local gossip associated with a drawn-out legal fight. We have observed historical trends where rural residents settle for pennies on the dollar because they want to preserve their reputation at the local church or coffee shop, not realizing they are signing away their ability to afford healthcare or housing 20 years down the line. Step by step, the process of dividing a 401k in these communities usually follows a predictable yet treacherous path. It starts with the discovery phase. In rural settings, documentation can be spotty. Perhaps the employer is a small local firm that doesn't use a major national payroll provider. Finding the Summary Plan Description (SPD) becomes a chore. Without this document, you don't even know if the plan allows for a separate interest or a shared payment approach. Two very different ways of getting paid. If you choose the wrong one, you could be waiting until your ex-spouse retires before you see a single dime of your settlement, even if you are already at retirement age yourself. As we move forward in this masterclass, we are going to dive into the specifics of the QDRO process, the secret paperwork that actually moves the money. Many people think the divorce decree is the final word. It isn't. The plan administrator of a 401k doesn't care what a judge's divorce decree says. They only care about a QDRO that meets their specific plan requirements. If that document isn't drafted perfectly, the money stays put, and the legal fees start piling up. In the next section, we will look at real-world examples of how rural residents have successfully and unsuccessfully navigated this bureaucratic minefield, and what you can do to ensure your retirement remains a reality, not a memory. To truly grasp the gravity of 401k division in a rural context, we have to look at the specific legal mechanism that acts as the bridge between a state court order and a federal retirement plan. This is the Qualified Domestic Relations Order, or the QDRO. Many people in small-town America mistakenly believe that once the judge signs the divorce decree, the financial work is finished. Imagine a resident named Robert in rural Nebraska. In 2026, after 22 years of marriage, Robert and his spouse reach a settlement where he agrees to give her 50% of his 401k balance, which stands at $300,000. The judge signs the decree, Robert hands a copy to his ex-wife, and they both walk away thinking the deal is done. 6 months later, Robert's ex-wife tries to access the funds to put a down payment on a small house in town, only to find out that the 401k administrator has no record of the transfer. This happens because a 401k is a creature of federal law under ERISA, while a divorce is a creature of state law. The plan administrator at Robert's company is legally forbidden from moving money out of his account based on a standard divorce decree. They require a very specific, highly technical document called a QDRO. If Robert's attorney, who might be a general practitioner in a county with only 3 lawyers, doesn't know the exact language required by that specific 401k plan, the document will be rejected. This creates a terrifying legal limbo. Historical trends show that some rural divorcees go years without realizing their QDRO was never finalized, only to find out when they reach retirement age that the money was never moved, leading to massive legal bills to reopen a case from a decade prior. Let's expand on the step-by-step technicalities of the QDRO, because this is where the most significant financial damage occurs. The process begins with obtaining the summary plan description from the employer. In rural U.S. communities, this can be difficult if the employer is a local franchise or a small manufacturing hub that has changed ownership several times. You must identify whether the plan allows for a separate interest approach or a shared payment approach. Imagine a scenario where a spouse is awarded a portion of a 401k, but the plan only allows for shared payments. This means the non-employee spouse cannot touch a dime until the employee spouse actually retires and starts taking distributions. If the employee spouse decides to work until they are 75, the ex-spouse is stuck waiting, regardless of their own financial needs. This lack of liquidity can be devastating in a rural economy where cash flow is often tight. Another layer of complexity is the valuation date. In a volatile market like we are seeing in 2026, the value of a 401k can swing by tens of thousands of dollars in a single month. If the divorce decree says the spouse gets half of the account, but doesn't specify a valuation date, which date does the plan administrator use? Is it the date of separation? The date the divorce was filed? Or the date the QDRO is finally processed? Case studies have shown that a delay of just 90 days in filing a QDRO during a market downturn can result in a spouse receiving significantly less than they expected, leading to further litigation and animosity. In rural areas where everyone shops at the same grocery store, these financial disputes aren't just numbers on a page. They become lifelong social burdens. Now, let's talk about the tax trap of 2026. This is perhaps the most misunderstood aspect of 401k division in rural America. When a 401k is split via a QDRO, the money can typically be rolled over into the recipient's own IRA without any immediate tax penalty. However, many people in rural communities, facing the immediate costs of setting up a new household, choose to take a cash distribution instead of a rollover. They see $100,000 in the 401k and think they are getting $100,000 in cash. They are not. If they take the cash, the plan is required to withhold 20% for federal income taxes immediately. Furthermore, if they are under the age of 59 and a half, they might assume they will hit with a 10% early withdrawal penalty. While there is a specific exception for QDRO distributions that avoids the 10% penalty, the regular income tax still applies. A rural resident might take a $50,000 distribution to buy a used truck and pay off some debt, only to realize at the end of the year that they owe the IRS an additional $12,000 because the distribution pushed them into a higher tax bracket. Imagine a character named Sarah in a rural part of West Virginia. Sarah's ex-husband had a substantial 401k from his years working for a national logistics company. As part of their 2026 divorce, Sarah received $60,000. Instead of rolling it into an IRA, she used it to repair the roof on her farmhouse and settle some medical bills. Because she didn't account for the fact that the $60,000 was pre-tax money, she found herself in a situation where her tax liability for the year exceeded her actual remaining cash. This is a common historical trend in rural areas where financial literacy regarding complex tax-deferred assets is often overshadowed by immediate, tangible needs. We also have to consider the impact of 401k loans. In many rural households, the 401k isn't just a retirement fund. It's the family's emergency bank. It is very common for a worker to have an outstanding loan against their 401k to pay for a child's college or a major home repair. When a divorce occurs, how is that loan handled? If the account has a balance of $100,000 but a $20,000 loan, is the marital asset $80,000 or $100,000? If the court orders a 50-50 split of the $100,000, the employee spouse might find themselves responsible for paying back a loan on money that was given to their ex-spouse. This can lead to a default on the loan, which the IRS then treats as a taxable distribution, creating a massive tax bill for the employee spouse at the worst possible time. The depth of this issue extends into the very nature of rural employment. Many rural workers are part of traditional pension plans in addition to 401ks, particularly those in government, utility, or unionized trade jobs. The interplay between a 401k and a pension during a divorce is a masterclass in itself. While the 401k is a defined contribution plan with a clear balance, the pension is a defined benefit plan that requires an actuary to determine its present value. In many rural divorces, the 401k is traded away to keep the pension or vice versa. Without a professional valuation, one spouse often ends up with an asset that is worth far less in the long run. Think about the long-term potential outcomes for a community where these mistakes are repeated. When a large segment of the aging population in a rural county loses a significant portion of their retirement to taxes and legal fees during a divorce, the entire local economy feels the pinch. There is less disposable income to support local businesses, and more reliance on overstretched county social services. This isn't just an individual tragedy, it's a systemic rural issue. But there is a way to navigate this that involves more than just luck. It involves understanding the specific language of the plan, the timing of the filings, and the tax implications of every move. You have to look at the 401k not as a pot of money, but as a complex contract with the federal government and an employer. If you treat it like a simple bank account, you will lose. We have to look closer at what happens when the 401k isn't the only asset on the table. What happens when you have to choose between the 401k and the family land? This is where the decisions become permanent and the stakes become absolute. In the next part, we are going to break down the specific math of the offset strategy. We will look at why taking the house instead of the 401k is often a mathematical trap that looks good in the short term but leads to poverty in the long term. We will also explore the hidden fees that plan administrators charge just to review your QDRO. Fees that can eat up thousands of dollars before a single cent is even moved. And most importantly, we will discuss the one person you must talk to before you sign anything, and it isn't your lawyer or your ex-spouse. Do you know how to calculate the real-world value of a tax-deferred dollar versus a post-tax dollar in a rural economy? If not, you are already behind. Calculating the real-world value of a tax-deferred dollar versus a post-tax dollar is the single most important mathematical hurdle in a rural divorce. Yet it is where most people fail. To understand the offset strategy, we have to look at the math through the lens of a character named David in rural Wisconsin. In 2026, David is navigating a divorce where the primary assets are the family home, valued at $250,000 with no mortgage, and his 401k, which also has a balance of $250,000. On the surface, this looks like a perfect 50-50 split. David's spouse wants the house to remain in the community near her aging parents, and David wants to keep his retirement fund intact. They agree to an offset. She takes the house, he takes the 401k. From a bird's eye view, both parties walk away with $250,000 in net worth. However, historical trends in financial planning suggest that David has just made a catastrophic error. The house is a post-tax asset. If David's spouse sells that house tomorrow, assuming it is her primary residence and she meets the IRS residency requirements, she can likely shield up to $250,000 of the gain from capital gains taxes. She has $250,000 of actual spendable purchasing power. David, on the other hand, holds a 401k. Every single dollar in that account is a tax-deferred liability. When David reaches retirement age and begins withdrawing that money, the federal government and the state of Wisconsin will take their cut. If David is in a 22% federal tax bracket and a 5% state bracket, his $250,000 is actually worth roughly $182,500 in real-world spending power. By agreeing to an even swap based on the face value of the account, David has effectively gifted his ex-spouse nearly $67,500 without realizing it. In rural U.S. communities, this disparity is often ignored because the emotional value of the home or the family land is so high. People want the security of the roof over their heads, or they want the simplicity of keeping the account they've watched grow for decades. But the offset strategy requires a much deeper level of scrutiny. You must apply a tax adjustment discount to any retirement account before comparing it to a liquid or tangible asset like a house, a vehicle, or a savings account. Case studies show that successful negotiations in 2026 often involve a 20 to 25% haircut on the 401k's value for the purpose of the offset. If David had understood this, he would have demanded an additional $30,000 or $40,000 from other marital assets to balance the true utility of the two piles of money. Now let's move into the hidden administrative costs that often blindside rural residents. When you submit a QDRO to a plan administrator, you aren't just sending a letter to a friendly HR representative. Most large 401k plans use third-party administrators who specialize in ERISA compliance. These administrators charge fees to review, process, and implement a QDRO. In 2026, these fees typically range from $500 to $2,500 per order. In a high-stakes corporate divorce, $1,000 might seem like a rounding error. But in a rural community where the median household income might be $55,000, this is a significant blow. The question then becomes, who pays the fee? If the divorce decree is silent on this matter, the plan administrator will often deduct the fee directly from the 401k account itself. Imagine a scenario where a spouse is awarded exactly $50,000 from a 401k. If the plan administrator charges a $1,200 review fee and deducts it from the payout, that spouse receives $48,800. If that spouse was counting on that $50,000 for a specific purpose, like paying off a high-interest agricultural loan or securing a new rental agreement, they are suddenly short. We have seen historical trends where disputes over these administrative fees lead to secondary legal battles that cost more than the fees themselves. The solution, which is often missed in small-town legal offices, is to explicitly state in the divorce decree or the QDRO itself how these fees are to be split, whether they are shared 50-50, paid entirely by the participant, or paid by the alternate payee. Beyond the fees and the tax math, we have to address the issue of investment risk during the shadow period. This is the time between when the judge signs the divorce decree and when the 401k administrator actually moves the funds. In 2026, this shadow period can last anywhere from 3 months to a year, depending on the complexity of the plan and the speed of the attorneys. Imagine a resident named Linda in rural Georgia. The court awards her 50% of her ex-husband's 401k on a day when the market is at an all-time high. The account is worth $200,000, so she expects $100,000. However, the QDRO isn't finalized for 7 months. During those 7 months, the market takes a 15% dip. If the QDRO was drafted to give Linda a fixed dollar amount of $100,000, the husband bears the entire burden of the market loss. He might be left with only $70,000 in his half of the account because Linda gets her $100,000 no matter what. Conversely, if the QDRO was drafted to give her 50% of the account balance as of the date of transfer, Linda is the one who suffers the $15,000 loss. In rural courts, where generic forms are often used to save on legal costs, the failure to specify whether the award includes investment gains and losses is a frequent source of disaster. You must ensure the language is precise. Does the award include earnings and losses from the date of valuation to the date of distribution? Without that clause, you are essentially gambling with your retirement on the speed of a bureaucrat's pen. There is also the matter of the missing participant. In rural areas, companies close, merge, or move operations frequently. If you are trying to divide a 401k from a job your spouse held 10 years ago at a local mill that has since been bought out by a multinational corporation, the paper trail can be cold. Finding the current plan administrator requires a level of digital detective work that many local law firms aren't equipped to handle. You might find yourself needing to contact the Department of Labor or use the abandoned plan search tools provided by the Pension Benefit Guaranty Corporation. Case studies from 2026 suggest that as many as 15% of rural retirement assets are stale, meaning they are sitting in accounts where the contact information is decades out of date. Everything we've discussed so far leads to a singular point of failure: the lack of a specialized team. Most rural residents believe a divorce is a legal event, so they only hire a lawyer. But a 401k divorce is a financial event that happens to have a legal component. You are dealing with the Internal Revenue Code, actuarial tables, and market volatility. If you don't have someone who can run the numbers on a tax-adjusted basis, you are fighting with one hand tied behind your back. This brings us to the one person you must talk to before signing a settlement. This person isn't there to argue about who gets the furniture. They are there to project your cash flow in the year 2040 based on the decisions you make today. If you think you can just eyeball the division of a 401k and come out even, you are ignoring the reality of the American tax system and the complexity of federal law. The stakes are too high, and the rural economy is too unforgiving of these types of mistakes. But what happens when the 401k isn't just an account? What if it's tied to a company that's about to go under? Or what if the spouse has been secretly taking loans against it for years? In the next part, we are going to expose the dark side of 401k division, fraud and asset depletion. We will look at the specific ways a spouse can hollow out an account before the QDRO is ever filed, and the 3 red flags you need to look for in your spouse's quarterly statements that prove they are hiding money. If you've noticed a sudden change in their behavior or a lack of transparency regarding their mail, you might already be a victim of 401k leeching. Do you know how to spot a phantom loan? You're about to find out. The concept of a phantom loan is one of the most sophisticated ways an account can be depleted right under your nose in a rural U.S. community. In these areas, the local HR office of a manufacturing plant or a regional hospital might have a long-standing personal relationship with your spouse. This familiarity sometimes leads to a lack of rigorous verification when a participant requests a loan against their 401k. Imagine a character named Mark in rural Kentucky in 2026. Mark knows his marriage is failing long before his wife, Elena, does. To siphon off marital assets, Mark takes out the maximum allowable loan from his 401k, which is 50% of his vested balance or $50,000, whichever is less. He claims the funds are for home repairs or a family emergency. By the time Elena files for divorce and her attorney requests a statement of the account, the balance appears significantly lower than it was 6 months prior. Because many rural residents only look at the bottom line number on a quarterly statement, Elena doesn't realize that $50,000 of that balance is now a debt that Mark has already pocketed in cash. In a rural court, if this loan isn't specifically identified as a dissipation of marital assets, the court might split only the remaining equity in the account. Mark keeps the $50,000 he took out, and then receives half of what is left. This is a classic case study in how the lack of a forensic review can lead to lopsided potential outcomes. To spot this, you must look for a line item on the statement typically labeled as loan balance or participant loan. If you see a balance there that you didn't agree to, you are likely looking at a phantom loan designed to preemptively drain the retirement pot. Another common method of asset depletion in these communities is the aggressive shifting of investment allocations. In the year 2026, market volatility remains a significant factor for rural families who rely on stable growth. Imagine if a spouse anticipating a divorce moves the entire 401k portfolio from a diversified mix of stocks and bonds into a high-risk, speculative sector or, conversely, into a low-yield money market fund during a high-growth period. This isn't always done out of malice. Sometimes it is a misguided attempt to protect the money. However, if the account loses significant value because of a radical change in investment strategy made without the other spouse's knowledge, the court may view this as a form of financial waste. Historical trends show that rural courts are increasingly willing to credit the non-employee spouse with the value the account would have had if it had remained in its original, diversified state. But proving this requires a step-by-step analysis of the account's transaction history. You need to look at every single trade made in the 12 to 18 months leading up to the divorce filing. Are there sudden sell-offs? Are there massive transfers between sub-accounts? In rural settings where the local bank might also be the 401k custodian, these records are often accessible, but you have to know to ask for the plan participant history, not just the current balance. Let's talk about the red flag of the missing mail. In many traditional rural households, one spouse handles all the financial paperwork. If you suddenly stop seeing the quarterly 401k statements in the physical mail, or if the login credentials for the online portal have been changed without your knowledge, this is a major warning sign. In 2026, many plans have moved to paperless delivery by default. A spouse can easily change the associated email address to a private account you cannot access. This creates an information vacuum. Without the statements, you cannot track the balance, you cannot see if loans are being taken out, and you cannot verify the beneficiary designations. Changing a beneficiary designation is a common, though often legally ineffective, tactic used in rural divorces. A spouse might remove their partner as the primary beneficiary and name a sibling or a child from a previous marriage instead. While ERISA law generally requires a spouse's written consent to waive their right to be the primary beneficiary of a 401k, many people attempt to bypass this through administrative errors or by using outdated plan documents. If the participant spouse were to pass away before the divorce is finalized, the non-participant spouse could find themselves in a grueling legal battle with a third party over the retirement funds. We must also examine the case of the cash-out coercion. This occurs when a spouse is pressured into signing a waiver or an agreement that allows the participant to withdraw funds prematurely. Imagine a scenario in a small town in North Carolina. The family is struggling with the high cost of farm equipment or a sudden medical bill. The spouse with the 401k convinces the other that they must take a hardship withdrawal to save the family business. In reality, the participant spouse is using the crisis to liquidate the asset before it can be divided in the impending divorce. Because hardship withdrawals are subject to strict IRS rules and often carry heavy tax penalties, the marital estate is doubled hit. First by the loss of the asset, and second by the tax liability and the loss of future growth. Historical trends indicate that these types of financial maneuvers are more prevalent in rural areas, because there is often less oversight and fewer specialized professionals to blow the whistle. In a city, a high-asset divorce might involve a team of 4 or 5 experts. In a rural county, it might just be you, your spouse, and 2 lawyers who are trying to settle 10 other cases that same day. This lack of scrutiny creates a fertile ground for asset leaching. To protect yourself, you need to implement a strategy of financial transparency as soon as a separation is even considered. Step 1 is a full document pull. This includes the last 3 years of 401k statements, the summary plan description, and a copy of any loan applications associated with the account. Step 2 is a formal notice to the plan administrator. While the administrator cannot freeze the account based on a phone call, your attorney can issue a joinder or a notice of adverse interest, which effectively puts the plan on notice that a divorce is pending. This can sometimes prevent the administrator from processing new loans or beneficiary changes until the court issues a final order. Step 3 is the comparison of the 401k balance to other financial markers, such as the tax returns. If the 401k contributions listed on the W-2 don't match the growth on the statements, something is wrong. Consider the example of a couple in rural Iowa. The wife noticed that her husband's 401k balance seemed to stay flat for 2 years despite him claiming he was contributing the maximum amount allowed by law. Upon a deep dive into the records, it was discovered that he was indeed contributing, but he was also taking out monthly revolving loans to fund a separate bank account in another state. This was only caught because she compared the year-end 401k statement to the total contributions listed on their joint tax return. The math didn't add up. In a deep dive masterclass like this, we have to emphasize that the 401k is often a window into the broader financial health and honesty of the marriage. If there is fraud in the retirement account, there is likely fraud elsewhere, in the valuation of the family home, the reporting of side income, or the disclosure of debts. But the 401k is unique because it is so heavily regulated and documented. It is often the easiest place to find the first thread that unravels a larger tapestry of financial deception. As we move toward the next segment, we have to look at the other side of the coin. What happens if the 401k isn't being drained, but it's being used as a weapon? What if the participant's spouse refuses to sign the QDRO, effectively holding your retirement hostage for years? This is the stalling tactic, and in rural courts with backlogged dockets, it can be a death sentence for your financial future. We are going to look at the specific legal motions you can file to force a signature, and how to bypass a recalcitrant spouse entirely by going directly to the plan administrator with a court-certified order. In the next part, we will explore the nightmare of the post-divorce 401k crash. What happens if you get your 50%, but the company goes bankrupt before the transfer is complete? Or if the plan administrator makes a mistake that costs you $20,000 in fees? We will also cover the rarely discussed impact of the 2026 inflation rates on long-term 401k projections in rural communities. If your settlement is based on $2024 but paid out in $2026, you might be losing more than you think. Do you know the difference between a nominal payout and a real value payout? You're about to find out why that distinction is the difference between a comfortable retirement and working until you're 80. The distinction between a nominal payout and a real value payout is the silent killer of retirement dreams in rural America, especially as we navigate the economic landscape of 2026. In a nominal payout scenario, you are looking at the raw number on the page. If the court awards you $100,000 from a 401k, that is the nominal value. However, the real value payout accounts for inflation, taxes, and the purchasing power of those dollars in your specific local economy. In rural areas where specialized goods or services might already carry a premium due to transportation costs, a dollar doesn't always go as far as the national CPI might suggest. If your divorce proceedings drag on for 2 years and the $100,000 remains stagnant while inflation remains at 3 or 4%, you haven't just lost time. You've lost the ability to buy the same amount of propane, groceries, or livestock feed that you could have purchased when the process began. Consider a case study involving a resident named Thomas in rural Idaho. In early 2024, Thomas and his spouse agreed to a split where Thomas would receive a nominal sum of $150,000 from a 401k. Due to a series of administrative delays and a backlogged county court system, the QDRO wasn't finalized and executed until mid-2026. During that 2.5-year window, the nominal value remained $150,000 because the agreement didn't include language for investment gains or interest. However, the cost of living in his rural county spiked by 8% over that same period. When Thomas finally received his funds, the real value payout, measured in 2024 purchasing power, was only worth approximately $138,000. He lost $12,000 of utilities simply because his settlement didn't account for the temporal nature of money. This is why historical trends suggest that savvy negotiators in 2026 are increasingly pushing for percentage-based splits rather than fixed dollar amounts, as percentages allow your share to move with the market and, to some extent, hedge against the eroding power of inflation. Step by step, you must evaluate the time value of your settlement. First, identify the date of valuation. This is the moment the dollar amount is fixed. Second, calculate the expected duration of the QDRO process. In 2026, the national average for a contested QDRO to move from drafting to funding is roughly 7 to 9 months. But in rural jurisdictions with limited judicial resources, this can double. Third, compare your expected nominal payout against the projected cost of living adjustments. If the math shows a significant gap, you may need to negotiate for a larger share to compensate for the loss of real-world value during the transition period. Now, let's address the nightmare of the post-divorce 401k crash and employer instability. In many rural communities, a single large employer, such as a paper mill, a meatpacking plant, or a regional hospital, provides the 401k plans for a massive percentage of the population. If that employer faces financial hardship or bankruptcy during your divorce, the status of your 401k division becomes incredibly precarious. While 401k assets are generally held in trust and are protected from an employer's creditors under ERISA, the administrative process can grind to a halt. If a company goes into Chapter 11 bankruptcy, the plan administrator might be replaced, or the plan might be frozen. Imagine a scenario in a small town in Pennsylvania where the local textile factory, the largest employer for 3 counties, suddenly announces a restructuring in 2026. A resident named Susan is in the middle of a divorce and is waiting for her $50,000 401k transfer. Because the company is in turmoil, the HR department stops processing QDROs. Susan is left holding a court order that no one is acting upon. In historical trends, these freezes can last for months or even years. During this time, Susan has no access to the funds, cannot roll them over to an IRA, and cannot change the investment allocations. If the market takes a downturn while the plan is frozen, Susan is forced to watch her retirement disappear with no legal recourse to move the money. This is the danger of being tied to a single employer plan in a volatile rural economy. To mitigate this, you must look for the prompt execution clause in your legal strategy. This involves setting strict, court-mandated deadlines for the submission and approval of the QDRO. If the participant's spouse or the employer fails to meet these deadlines, your attorney can request that the court appoint a special master to sign the documents on their behalf. In 2026, we are seeing more rural judges willing to take this step to prevent one spouse from being unfairly prejudiced by corporate or administrative delays. We also have to discuss the rarely mentioned administrator error. With the rise of automated systems in 2026, many 401k transfers are handled by algorithms and offshore processing centers. It is not uncommon for a decimal point to be misplaced or for a tax withholding to be calculated incorrectly. Imagine receiving your payout, but the administrator accidentally withheld 40% for taxes instead of 20%, or they transferred the funds into a taxable brokerage account instead of the IRA you specified. Correcting these errors after the fact is a bureaucratic odyssey. You would be dealing with the IRS to claw back overpaid taxes, and the plan administrator to fix the ledger. Case studies show that it can take over a year to rectify a major administrative error, during which time your money is not working for you. To protect yourself, you need a verification protocol. Before any money moves, you must receive a pre-approval letter from the plan administrator stating that the QDRO is qualified and outlining exactly how much will be moved and where it will go. You should never allow a transfer to occur without this written confirmation. Furthermore, you must double-check the routing numbers and account types for your receiving IRA. A single-digit error in a rural bank's routing number can send your retirement into a suspense account where it could sit for weeks while the banks argue over who is responsible. The 2026 economic environment also brings the interest rate paradox into play. If your 401k is heavily invested in fixed income assets or stable value funds, which are popular in conservative rural portfolios, rising interest rates can actually decrease the market value of the underlying bonds. If you are awarded a share of the account during a period of shifting rates, the value you see on your statement might not be the value you can actually liquidate. You have to ask your financial professional to explain the duration risk of the 401k's bond holdings. Are you getting a slice of a portfolio that is losing value as rates go up? In rural America, where safe investing is the norm, this hidden risk catches thousands of divorcees every year. Everything we've covered in this part highlights one truth: the gap between getting a fair settlement on paper and actually having that money in your hand is filled with traps. The 401k is a living, breathing financial entity that changes every second the market is open. If your legal and financial strategy is static, you are losing. You need to be as dynamic as the account itself. But what happens if you do everything right? You get the money, and then the IRS comes knocking because of an error your ex-spouse made 5 years ago. This is the joint liability ghost, and it can haunt your 401k even after the divorce is final. In the next part, we are going to dive into the terrifying world of IRS offsets and how your ex's past tax mistakes can lead to the government seizing your newly divided retirement funds. We will also explore the innocent spouse defense and why it is your only shield against a 401k seizure. Do you know if your ex-spouse has been honest with the IRS? If you don't, your 401k is still at risk. We're going to show you how to audit the past to protect your future. The joint liability ghost is a financial haunting that many rural Americans never see coming until the IRS notice arrives in their mailbox. In the United States, when you file a joint tax return, you are essentially telling the federal government that you are a single economic unit, sharing both the rewards and the liabilities of your financial life. Even after a divorce is finalized in 2026, the IRS can still look back at those joint filings from 3, 5, or even 7 years ago. If your ex-spouse underreported income from a side business, claimed fraudulent agricultural deductions on a family farm, or failed to pay self-employment taxes, the IRS doesn't care that you are now living in separate houses. They can, and often do, pursue the most accessible assets to satisfy that debt. In many cases, that asset is the newly divided 401k sitting in your name. Imagine a scenario involving a woman named Mary in a rural township in Michigan. In 2026, Mary successfully navigated her divorce and walked away with $120,000 from her ex-husband's 401k via a properly executed QDRO. She rolled that money into a traditional IRA and began planning her future. However, unbeknownst to Mary, her ex-husband had been aggressive with their tax filings during the early 2020s, overstating the depreciation on their farm equipment to lower their tax bill. 2 years after the divorce, the IRS completes an audit of those joint returns and determines the couple owes $45,000 in back taxes, interest, and penalties. Because Mary's ex-husband has since lost his job and has no liquid assets, the IRS looks at Mary. They see a $120,000 retirement account and issue a notice of levy. Without the proper legal protections, Mary could watch over a third of her retirement vanish to pay for a mistake she didn't even know was made. Historical trends show that this is not an isolated incident. In rural communities where small businesses and family farms are the backbone of the economy, tax returns are often complex and prone to errors or aggressive positions. This is where the innocent spouse relief comes into play. To protect your 401k from being seized for your ex-spouse tax blunders, you must understand the criteria for this defense. The IRS recognizes 3 types of relief: innocent spouse relief, separation of liability relief, and equitable relief. To qualify for innocent spouse relief, you must prove 3 things step by step. First, you must show that you filed a joint return that has an understatement of tax directly related to the erroneous items of your spouse. Second, you must establish that at the time you signed the joint return, you did not know, and had no reason to know, that there was an understatement of tax. Third, taking into account all the facts and circumstances, it must be shown that it would be unfair to hold you liable for the understatement. In a rural setting, the reason to know standard is the most difficult hurdle. If you were the one who balanced the farm's books, or if you enjoyed a lifestyle that clearly exceeded your reported income, the IRS may reject your claim. Case studies from 2026 suggest that the IRS is becoming more stringent in evaluating these claims, requiring detailed documentation of financial roles within the marriage. But even if you win an innocent spouse claim, there is another ghost in the machine: the Federal Debt Collection Procedures Act. This allows the government to place a lien on marital property to satisfy federal debts. If your ex-spouse owed student loans, back child support from a previous marriage, or restitution from a legal judgment, those debts can sometimes attach to the 401k before it is even divided. If the 401k is in your ex-spouse's name, and they have an outstanding federal debt, the plan administrator might be legally required to pay the government before they process your QDRO. This means your 50% share isn't 50% of the total account, but 50% of what's left after the government takes its cut. To prevent this, you must conduct a pre-divorce financial audit. This isn't just looking at bank statements, it's looking at public records and tax transcripts. In 2026, you can request a tax account transcript from the IRS for every year you filed jointly. This document will show you any assessments, penalties, or unpaid balances that are currently on the books. In rural areas where the local courthouse might not have everything digitized, you also need to check for state-level tax liens or local property tax delinquencies. If you find a debt, you must address it in the divorce decree. You cannot simply say, "The husband is responsible for all past taxes." The IRS is not a party to your divorce decree and is not bound by it. You need a hold harmless and indemnification clause, but more importantly, you may need to set aside specific assets in an escrow account to cover potential tax liabilities uncovered during the discovery process. Let's look at the concept of asset tracing in the context of 401k funds. Suppose your spouse argues that a portion of the 401k is separate property because they started the account before the marriage. In rural communities, people often work the same job for 40 years. If the marriage lasted 20 years, the math seems simple, but it isn't. You have to account for the commingling of funds. If the account was worth $10,000 at the time of the wedding and $200,000 at the time of the divorce, the growth on that initial $10,000 is often considered marital property in many states, while the $10,000 itself remains separate. However, if the spouse took a loan from the 401k during the marriage to pay for a joint expense and then paid it back using marital wages, the separateness of that initial $10,000 may be legally compromised. Tracing these funds requires a year-by-year reconstruction of the account. In 2026, where digital records are more prevalent, this is easier than it was 20 years ago, but it still requires a high level of diligence. If you cannot prove the separate nature of the funds with clear documentation, many rural judges will default to the assumption that the entire account is marital property. For the spouse trying to protect their premarital nest egg, this is a disaster. For the spouse trying to get their fair share, this is an opportunity. Another layer of risk involves the plan termination trap. As we move deeper into 2026, many smaller rural companies are moving away from traditional 401k plans toward cheaper, automated alternatives or state-sponsored retirement programs. If a plan is terminated while your QDRO is in process, your money might be transferred into a default IRA, selected by the employer. These default IRAs often have high fees and low-yield investment options. If you don't act quickly to move those funds into an IRA of your own choosing, you could lose thousands of dollars in potential growth over the following years. The reality of 401k divorce in rural U.S. communities is that you are not just fighting your ex-spouse, you are navigating a maze of federal regulations, tax codes, and corporate administrative hurdles. The people who come out ahead are the ones who treat the process with the clinical precision of a business merger. You must verify every claim, audit every year of joint history, and assume that every document contains a potential error until proven otherwise. But what happens when the 401k isn't just an account with a company, but is actually tied to a family business? What if your spouse is the owner of the company and the trustee of the 401k plan? This is the ultimate conflict of interest, and it happens every day in small-town America. In the next part, we are going to expose the owner-occupied 401k, and how a spouse with administrative control can manipulate the plan's valuation, delay distributions indefinitely, and even invest the 401k funds into their own failing business ventures to keep them out of your hands. If your spouse is their own boss, your retirement is in a whole different kind of danger. Do you know how to remove a biased trustee from a retirement plan? We're about to show you the legal leverage you didn't know you had. The owner-occupied 401k, often structured as a solo 401k or a small business retirement plan where the business owner acts as the trustee, represents the ultimate conflict of interest in a rural U.S. divorce. In these scenarios, the person you are divorcing is the same person who signs the checks, manages the investment ledger, and communicates with the plan's third-party administrator. This creates a power imbalance that can be exploited in ways a corporate HR department would never allow. Imagine a resident named Jackson in rural Montana. In 2026, Jackson owns a successful regional HVAC and plumbing company. For 15 years, he has been the trustee of his company's 401k plan. His spouse, Sarah, has spent those years managing the office and raising their children. When they file for divorce, Sarah discovers that Jackson has a level of control over the retirement funds that makes her share feel more like a suggestion than a legal right. Because Jackson is the trustee, he has the power to influence the valuation of the plan's assets. In small-town America, many business owner 401ks hold non-traditional assets, such as real estate used by the business or even private equity in local ventures. Unlike a stock portfolio with a ticker symbol, these assets require subjective appraisal. Jackson might provide an appraisal that significantly undervalues the commercial lot held within the 401k to lower the total amount he has to pay Sarah. This is a classic case study in rural financial manipulation. Historical trends indicate that without an independent valuation, the non-owner spouse is at the mercy of the owner's reported numbers. To combat this, you must realize that as a potential alternate payee, you have federal rights under ERISA to demand a full accounting of the plan's assets, including the methodologies used for valuation. Step by step, the process for challenging a biased trustee begins with a formal demand for the summary plan description and the latest Form 5500. In 2026, even small plans must file these with the Department of Labor. If the owner spouse refuses to provide these, they are in violation of federal law, which carries hefty daily penalties. Once you have the documents, look for the list of plan fiduciaries. If your spouse is the sole trustee, your attorney can petition the court for the appointment of a neutral third-party trustee or a receiver specifically for the retirement assets. This is the legal leverage many rural residents don't know they have. A judge in a rural county might be hesitant to interfere with a local business, but when presented with evidence of a fiduciary breach, such as the trustee using 401k funds to pay off business debts or making self-dealing investments, the court has the authority to strip that spouse of their control. Imagine if Jackson, sensing the impending divorce, decided to invest $100,000 of the 401k funds into a new, high-risk warehouse expansion for his company. On paper, the 401k still has the asset, but that money is now locked in a non-liquid investment that serves Jackson's business interests while preventing Sarah from receiving a cash rollover. This is a form of asset hollowing. In the eyes of the law, a trustee must act solely in the interest of the plan participants. By using the funds to benefit his own business operations during a divorce, Jackson has committed a prohibited transaction. Case studies from 2026 show that these types of maneuvers can lead to the court awarding the non-owner spouse a larger share of other liquid assets, like the family home or bank accounts, to offset the illiquid and compromised 401k funds. Another layer of this danger is the stalling of the QDRO approval. In a corporate setting, the QDRO goes to a legal department that follows a set timeline. In an owner-occupied plan, the owner spouse might simply sit on the document. They might claim they are reviewing it for months, or they might repeatedly reject it for minor typographical errors that they themselves have the power to waive. This is a common historical trend, used to exhaust the other spouse's legal budget. The solution is a motion for contempt or a specific court order that deems the QDRO qualified, if the plan administrator fails to provide a valid, written rejection within 30 days. In 2026, rural courts are becoming less tolerant of these administrative games, but you have to be proactive in bringing it to the judge's attention. We also have to consider the valuation of the business versus the valuation of the 401k. In many rural divorces, the 401k is tied so closely to the business's success that they cannot be separated. If the business is struggling in the 2026 economy, the 401k might be the only thing left of value. However, if the business owner has been taking excessive management fees out of the 401k to support the company's cash flow, the retirement account might be worth far less than the quarterly statements suggest. This is why you must look at the plan's trust accounting, not just the participant statements. You need to see where the money is actually sitting. Is it in a reputable brokerage? Or is it in a local bank account controlled entirely by the spouse? Consider a scenario where a business owner in rural Texas uses the 401k to provide loans to key employees to keep them from quitting during a labor shortage. While this might help the business, it puts the 401k assets at risk. If those employees leave or the loans go unpaid, the 401k takes the hit. As the non-owner spouse, you must ensure that your QDRO specifically protects you from these unsecured or non-performing assets. You want your 50% to be taken from the most liquid, secure portions of the plan, leaving the owner spouse with the riskier self-made investments. The depth of this conflict cannot be overstated. When the spouse is the boss, the line between personal wealth and corporate assets becomes blurred. In rural U.S. communities, this blurriness is often accepted as just the way we do business. But in a divorce, that lack of clarity is a weapon. You must treat the 401k as a separate legal entity from the business, even if the office for both is in the same building. This requires a level of financial forensics that goes beyond a standard divorce disclosure. You are essentially auditing a small corporation to find your retirement, Historical trends in 2026 suggest that many rural business owners are currently transitioning their plans to more complex structures to shield assets from potential litigation, including divorce. If you see a sudden change in the plan structure, such as a move from a 401k to a defined benefit plan or the introduction of a profit-sharing component, you need to investigate immediately. These changes can alter the vesting schedule or the way the marital portion is calculated, potentially cutting your future payout by thousands of dollars. As we wrap up this deep dive into the owner-occupied trap, remember that your greatest asset is information. The trustee has a legal obligation to be transparent, but they will only be as transparent as you force them to be. You have to be willing to look past the small business owner persona and see the plan fiduciary, who is accountable to federal law. But what happens when the 401k division is finally agreed upon, the trustee is bypassed, and the QDRO is signed, but you realize your spouse has already been siphoning off the future value of the account through something called Social Security integration? This is one of the most technical and devastating clauses hidden in some rural retirement plans. It allows the employer to reduce your 401k benefits based on the Social Security payments you are expected to receive. In the next part, we are going to break down the Social Security offset and how it can silently erase 20% of your expected retirement income without you ever seeing a single deduction on your statement. Do you know if your plan is integrated? If you don't check now, your 2026 settlement might be worth a lot less by 2030. Social Security integration is a complex and often invisible mechanism within certain retirement plans that can fundamentally shift the financial landscape for rural Americans in 2026. To understand how this works, we must look at the way federal law allows employers to tilt the scales of a retirement plan to account for the Social Security benefits they are already helping to fund through payroll taxes. Imagine a character named Michael who lives in a rural county in Tennessee. Michael has worked for the same local manufacturing firm for 28 years. He is going through a divorce and his spouse, Emily, is awarded 50% of his 401k account. They both assume this means a straight split of the current balance. However, Michael's plan is integrated with Social Security. This means the employer uses a permitted disparity formula. Essentially, the plan provides a lower contribution rate for income below the Social Security taxable wage base and a higher contribution rate for income above it. In a divorce context, if the QDRO does not account for how this integration affects the actual benefit calculation, Emily might find that her 50% share is significantly lower than a simple math equation would suggest. In rural areas where many workers fall into middle-income brackets right around that Social Security wage base, the impact of integration is most pronounced. Historical trends show that many participants and their spouses never realize the plan is integrated until the moment of distribution, which can lead to potential outcomes where the expected monthly or lump sum payout is reduced by 15 to 20%. Step by step, you need to determine if a plan is integrated by requesting the specific section of the summary plan description, titled Benefit Formula or Coordination with Social Security. If the plan is integrated, the math becomes far more difficult than a standard account split. You are no longer just dividing a pile of cash. You are dividing a benefit that is intrinsically linked to a future government payment. In 2026, as the conversation around the long-term solvency of the Social Security Trust Fund continues to make headlines in rural town halls, the risk of having a private retirement plan that is tied to those public benefits becomes a major strategic concern. If Social Security benefits are adjusted at the federal level in the future, an integrated 401k plan might see its internal calculations shift in ways that negatively affect the alternate payee. Let's expand on the permitted disparity rules under the Internal Revenue Code. These rules are designed to prevent plans from being top-heavy or discriminatory toward highly compensated employees, but they create a side effect during asset division. Imagine if Emily is counting on a specific dollar amount to afford a smaller home in her rural community. If the integration formula reduces the total marital portion by $10,000 because of Michael's projected Social Security credits, Emily is the one who bears that loss. Case studies from 2026 highlight that rural legal teams often overlook this coordination, leading to settlements that are fundamentally imbalanced from day one. You must ask, is the division based on the total accrued benefit or the net benefit after the integration offset? Beyond the integration trap, we have to look at the issue of vesting schedules in the rural workforce. In 2026, many regional employers use graded vesting schedules to encourage employee retention in a tight labor market. Imagine a resident named Robert in rural Kansas. Robert has been with the local utility company for 4 years. His 401k statement shows a total balance of $80,000, but only $48,000 of that is vested. During the divorce, his spouse, Jessica, might claim a right to half of the $80,000. However, if the divorce is finalized before Robert is 100% vested, that remaining $32,000, which represents the employer's matching contributions, might never actually materialize for Jessica. Historical trends in rural courts show a split in how judges handle unvested assets. Some judges will only divide the vested portion, while others will award a percentage of the unvested portion to be paid, if and when the employee spouse actually stays with the company long enough for it to vest. This creates a long-term dependency on your ex-spouse's career choices. If Robert quits or is laid off from the utility company in 2027, the unvested portion vanishes, and Jessica receives nothing from that half of the pot. In 2026, with the rural job market undergoing rapid shifts due to automation and corporate consolidation, the risk of an unvested balance never reaching maturity is higher than ever. Another critical point is the valuation of company stock within the 401k. In many rural U.S. communities, the 401k is not just a collection of mutual funds. It is heavily weighted in the employer's own stock. This is common in employee stock ownership plans or 401ks with a heavy ESOP component. The problem here is liquidity and valuation timing. If the company is a private or regional entity, the stock is not traded on a public exchange. The value is often determined once a year by an independent appraiser. If you are divorcing in October but the last valuation was in December of the previous year, you are using data that is 10 months old. In a volatile 2026 economy, that stock could be worth much less or much more than the last appraisal indicates. Think about a character named Sarah in a small town in North Carolina. Her husband's 401k consists primarily of stock in a regional textile firm. During the divorce, they value the stock at $50 a share based on the 2025 year-end report. However, by the time the QDRO is processed in mid-2026, the company has lost a major contract, and the internal valuation has dropped to $30 a share. If the divorce decree awarded Sarah a fixed dollar amount, the husband is left with almost nothing. If it awarded her a percentage of shares, Sarah is the one whose retirement just took a 40% hit before she even received it. Step by step, you must insist on a language that accounts for the most recent valuation or requires a mid-year appraisal if a significant corporate event has occurred. We must also discuss the role of the 401k as collateral for rural lifestyle assets. In many farming and ranching communities, the 401k is sometimes used to secure personal loans for equipment or land. While the 401k itself cannot be used as collateral for a business loan under ERISA, the participant can take a personal loan and use that cash for the business. If that loan is outstanding during the divorce, it creates a debt that must be accounted for. Case studies show that rural spouses often forget to ask if the 401k has been encumbered by these internal loans. If the loan isn't paid back, the IRS treats the balance as a distribution. If you receive half of a 401k that has a secret $20,000 loan attached to it, you might be inheriting a tax bill instead of an asset. Finally, let's talk about the survival benefit trap. In a rural setting, the distance to legal resources often leads to couples using do-it-yourself divorce kits or general templates. These templates often fail to address what happens if the participant spouse dies after the divorce, but before the 401k is fully divided and transferred. Without a specific clause in the QDRO that grants the ex-spouse the status of a surviving spouse for the purpose of the 401k, the money might revert to the plan or go to a secondary beneficiary like a new spouse or the participant's estate. This is a catastrophic outcome that can be avoided with one sentence of legal language, yet historical trends suggest it is missed in nearly 30% of rural QDRO filings. The depth of these technicalities is what separates a successful rural retirement from a financial tragedy. You are dealing with a system that was designed for corporate stability, being applied to the often unstable reality of rural life. If you don't look at the integration, the vesting, the stock valuation, and the survival benefits, you are only seeing a fraction of the total picture. But there is one more factor that is currently reshaping how 401ks are divided in 2026. It's the rise of the silver divorce in rural America. Couples splitting after 40 years of marriage who are already in the required minimum distribution phase. What happens when the government is already forcing you to take money out of the account while you are trying to split it in court? In the next part, we are going to dive into the RMD nightmare and how to divide a 401k that is already in payout mode without triggering a massive IRS penalty. We will also explore why the age of the spouses in 2026 is the most important variable in your tax strategy. If you are over 73, the rules change completely. Do you know how to split a check that's already being mailed? You're about to find out. The required minimum distribution, or RMD, is a ticking clock that becomes a primary focus for many rural American couples entering a silver divorce in 2026. Under the Secure 2.0 Act, which continues to shape retirement strategy today, once a participant reaches the age of 73, the IRS mandates that they begin withdrawing a specific percentage of their 401k every single year. In a rural context, where property taxes on agricultural land are rising and healthcare costs in remote areas are spiking, these RMDs are often the primary source of cash flow for a household. But when you introduce a divorce into the mix, the RMD becomes a logistical and tax minefield. Imagine a character named Henry in rural Maine. Henry is 74 years old and has a 401k balance of $500,000. According to IRS life expectancy tables, Henry must take a distribution of roughly $18,000 this year. However, Henry is in the middle of a divorce from his spouse, Martha. If the 401k is being split 50-50, the question is, who is responsible for the RMD that must be taken by December 31st? Historical trends show that if the account isn't transferred to Martha before the RMD deadline, Henry must take the full distribution and pay the associated income tax. If he fails to do so, the IRS penalty is a staggering 25% of the amount that should have been withdrawn. For a rural retiree on a fixed income, a $4,500 penalty is a catastrophic loss of utility. Step by step, the division of an account already in the RMD phase requires a specific timing strategy. First, the plan administrator must determine the RMD amount for the entire account for the current year. Second, the QDRO must specify how that RMD is to be shared. If the money is moved to the ex-spouse IRA, that ex-spouse then becomes responsible for their own RMD based on their own age. If Martha is only 68, she might not have to take an RMD on her half for another 5 years, allowing her portion to continue growing tax-deferred. This age gap creates a massive financial advantage for the younger spouse in a rural divorce, as they can effectively reset the RMD clock on their half of the assets. Case studies from 2026 suggest that many rural couples overlook the first-year RMD responsibility. If the 401k is split in June, but the RMD isn't taken until December, the plan administrator might default to sending the entire check to the original participant, Henry. If Henry has already spent his half of the remaining assets, he might not have the cash to give Martha her share of that RMD, leading to a post-divorce legal skirmish. You must ensure the QDRO explicitly states whether the current year's RMD has already been satisfied, or how it will be prorated between the parties. Furthermore, we have to look at the impact of the 2026 tax brackets on these late-life distributions. In rural communities, a sudden influx of RMD income can push a single filer into a much higher tax bracket than they occupied as a joint filer. When Henry and Martha were married, their combined RMDs were taxed at a lower effective rate due to the wider brackets for married couples. Now, as a single man in Maine, Henry's $18,000 distribution might be taxed at 22 or 24%, whereas before it might have been in the 12% range. This is the single filer penalty that many rural retirees fail to calculate during settlement negotiations. Let's expand on the scenario of the inherited 401k. In many rural families, a significant portion of the retirement nest egg might actually come from a 401k that one spouse inherited from a parent. In 2026, the rules for inherited 401ks are extremely rigid. If the spouse inherited the account after 2019, they are likely subject to the 10-year rule, meaning the entire account must be emptied by the end of the 10th year following the original owner's death. If this inherited account is considered marital property in your state, which it often is if marital funds were used to pay the taxes on distributions, the division becomes even more complex. You aren't just splitting an account. You are splitting a ticking tax bomb that must be fully liquidated by a specific date. Imagine a couple in rural Iowa where the wife, Carol, inherited a $300,401,000 from her father in 2021. By 2026, the divorce is in full swing. If Carol has to empty the account by 2031, any split with her husband, Jim, must account for the accelerated tax liability. If Jim takes half of the account, he also takes half of the 10-year deadline. Historical trends indicate that rural residents often treat inherited 401ks like standard 401ks, not realizing that the withdrawal rules are vastly different. This leads to potential outcomes where one spouse receives an asset they are forced to liquidate much faster than they intended, creating a massive tax bill that erodes the actual value of the settlement. We also need to address the Qualified Charitable Distribution, or QCD, which is a powerful tool for rural retirees that is often disrupted by divorce. A QCD allows a participant over age 70 and a half to move up to $100,000 directly from their 401k or IRA to a qualified charity without that money counting as taxable income. In many rural towns, this is how residents support their local churches, volunteer fire departments, or community foundations. When a 401k is split, the ability to make these tax-free donations is also split. If you were relying on QCDs to satisfy your RMD while supporting your local community, the reduction in your account balance might mean you can no longer meet your charitable goals while also covering your own living expenses. Think about the psychological impact of these late-stage financial shifts. In a rural U.S. community, your 401k balance isn't just a number. It is your shield against the nursing home or the loss of the family homestead. When that shield is halved at age 75, the anxiety can be overwhelming. This is why the tax strategy in 2026 must be focused on preservation of capital. You cannot afford to make a mistake with the IRS when you have no years left to work and earn back the loss. Every dollar lost to a penalty or an inefficient distribution is a dollar that won't be there for home health care or emergency repairs. Step by step, the audit of a silver divorce 401k should include a review of the last 5 years of RMD history. You need to ensure there are no looming penalties from past years where the distribution was calculated incorrectly. If the IRS discovers an RMD error from 3 years ago, they will come for the money now, and they will take it from the current balance regardless of who is currently holding the account. In a rural county where the local tax preparer might not be an expert in Secure 2.0 nuances, these errors are more common than you might think. As we move into the final phase of this masterclass, we have to synthesize everything we've learned. We've covered the QDROs, the tax traps, the owner-occupied conflicts, and the RMD nightmares. But there is one final piece of the puzzle that ties it all together: the execution gap. This is the distance between the day the judge signs the paper and the day the money hits your account. In the final part, we are going to give you the 2026 checklist for finality. We will show you the 3 documents you must keep in a fireproof safe for the rest of your life to prove the 401k was divided legally, and we will reveal the most common reason why 401k transfers fail at the very last second. If you think you are safe because the court case is over, you are missing the most dangerous part of the journey. Do you know what a letter of instruction is? Do you know why your bank might reject your 401k rollover even if the judge ordered it? In the final part of this series, we are going to close the loop on your financial security and show you how to cross the finish line with your retirement intact. The most important minute of your divorce is the minute after the judge leaves the room. Are you ready for it? The minute after the judge leaves the room is often the most dangerous time in a 401k divorce. In rural U.S. communities, there is a collective sigh of relief when the final decree is signed. You might shake your attorney's hand in the hallway of a small-town courthouse, drive past the local grain elevator, and believe that the weight of the world has finally shifted off your shoulders. But this is where the execution gap begins. The court has spoken, but the financial institutions have not yet acted. Between the legal finality of the courtroom and the actual funding of your new account lies a minefield of paperwork, deadlines, and administrative hurdles that can derail your entire retirement strategy if you are not vigilant in 2026. The first step in closing this gap is understanding the letter of instruction. Even with a court-certified QDRO in hand, many plan administrators require a specific set of directions from you, the alternate payee, on exactly where the money should go. Imagine a character named Linda in rural Missouri. She has her QDRO for $75,000. She assumes the company will just mail her a check. However, the plan administrator's policy is to never mail checks for QDRO distributions to prevent mail fraud. They require a letter of instruction detailing the receiving IRA's account number, the bank's routing number, and a signature guarantee from a local financial institution. In a rural setting, getting a signature guarantee, which is more rigorous than a standard notarization, can be a challenge. Your local credit union or small-town bank branch might not have the specific medallion stamp required for high-value transfers. If Linda sends her paperwork without this, the plan administrator will reject the request, and the clock resets. Historical trends show that these administrative rejections are the leading cause of multi-month delays. You must call the 401k Service Center before you send a single page to ask for their specific distribution package. Do not assume your lawyer has this, often they do not. Once the letter of instruction is sent, you enter the shadow period of the transfer. This is where the bank rejection trap lies. Imagine if Linda's new IRA was set up as a Roth IRA, but the 401k funds coming from her ex-husband were traditional pre-tax dollars. If she attempts to roll over pre-tax money into a post-tax Roth account without a specific conversion election, the receiving bank may reject the wire transfer or the check. If the check is rejected and mailed back to the employer, it can take weeks to track down. Meanwhile, those funds are out of the market. If the market rises 5% while your money is sitting in a corporate suspense account, you have lost thousands of dollars in potential outcomes that you can never claw back. Step by step, your 2026 checklist for finality must begin with the verification of receipt. Once the plan administrator confirms the QDRO is qualified, you must get a written statement of the exact balance to be transferred. Second, you must provide a clean, error-free path for the money. This means opening the receiving account at least 2 weeks before the transfer and verifying with that bank that they accept QDRO rollovers. Third, you must request a confirmation of the tax reporting. You need to ensure the 1099, our form issued at the end of the year, will be in your name for your portion, not your ex-spouse's name, to avoid a nightmare audit from the IRS. We must also discuss the 3 documents you must keep in a fireproof safe for the rest of your life. In rural America, where companies merge and records disappear, these are your only shield. Document 1 is the court-certified copy of the QDRO with the judge's original signature and the court's raised seal. Document 2 is the qualification letter from the plan administrator. This is the paper where the company officially admitted that the order met federal ERISA standards. Document 3 is the final account statement showing the zero balance transfer, or the final payout. Why is this necessary? Imagine it is 2036 and you are finally ready to retire. You go to draw on your IRA, and the IRS questions the source of that original 401k rollover, claiming it was an excess contribution. Without these 3 documents, you may struggle to prove the money came from a legal divorce settlement, potentially leading to back taxes and penalties. Case studies in 2026 have shown that the rise of digital-only HR platforms has actually made this harder for rural residents. If your ex-spouse company uses an automated portal that deletes records after 7 years, you cannot rely on them to have your paperwork. You are your own record keeper. If you lose that paper QDRO, and the rural courthouse where you divorced has a fire or a flood, which has happened in several small Midwestern counties, reconstructing your legal right to those funds becomes an expensive, uphill battle. Furthermore, let's look at the most common reason for last-second failure: the outstanding 401k loan that was never closed. We've touched on loans before, but at the execution stage, they are lethal. If the plan administrator discovers a loan that wasn't addressed in the QDRO's mathematical formula, they will often freeze the entire distribution until a new, amended QDRO is drafted and signed by the judge. In 2026, this can add another 6 months to the process. You must ensure your QDRO includes a catch-all clause for loans, stating whether the balance should be calculated including or excluding any outstanding participant debt. Think about the character of David in rural Oregon. David's transfer failed on the very last day because his ex-wife took a small hardship withdrawal for an emergency 2 days before the funds were moved. This changed the total account balance, making the dollar amount specified in the QDRO impossible to fulfill. The administrator rejected the order because the math no longer worked. To prevent this, your legal team should request a temporary freeze on all participant activity, loans, withdrawals, and allocation changes, the moment the QDRO is submitted for review. As we reach the conclusion of this masterclass, the final potential outcome you must prepare for is the post-transfer market correction. If you receive your funds during a market peak, and you leave them in a settlement fund or a low-interest cash account because you are too exhausted from the divorce to make investment decisions, you are losing to inflation. In 2026, the goal is not just to get the money. It is to get the money back into a productive, diversified portfolio that matches your new single-life risk tolerance. Your retirement needs as a single person in a rural community are different than they were as a couple. You may need more liquidity for home maintenance or a different growth trajectory to account for a smaller Social Security pool. Historical trends show that those who successfully navigate a 401k divorce in rural America are the ones who stay on the ball for 90 days after the divorce is final. They don't stop when the judge signs. They stop when the statement for their new account shows the correct balance. They verify the tax withholding, they secure their physical documents, and they consult with a financial advisor to reallocate the funds for their future. The American rural landscape is changing, and the way we protect our hard-earned savings must change with it. You have worked decades for this money. Do not let a clerical error or a missing signature guarantee be the reason you spend your golden years in financial stress. You now have the deep dive knowledge to see the traps before they spring. You know the language of QDROs, the reality of tax offsets, and the necessity of administrative follow-through. This masterclass has provided the blueprint for securing your share of the American dream, even when that dream is being divided by two. The journey from the courtroom to the bank is the most important walk you will ever take. Make sure every step is on solid ground. Your retirement isn't just a number. It's your independence. Protect it with the same diligence you used to earn it.